So I thought this morning we'd talk about a few things. Take a look at the market background. So think about what markets have been doing, what's been driving returns, and what we've actually seen going on in markets. Then have a look at what that might mean for looking forward. So where we think markets might be going, what returns might be looking like in the mid and further term. And then also give some thoughts about some things that we've seen in the market, some topical aspects. And we thought we'd talk about ESG and sustainability, because I think you can't do an investment presentation these days without covering those areas. And we can also touch briefly on the Mansion House reforms earlier this week and what those might mean for pension schemes from an investment perspective. So the first chart there is quite a busy chart, but I think it really tells the picture. So if we look at the top left, it's showing inflation and how inflation has developed over the last year or so across, you can see the UK, the US and the European region there. And the general pattern of increasing inflation, which I'm sure you're all very familiar with, and then we've seen a little bit of a pullback, not so much in the UK as we've seen certainly in the US, certainly in the EU as well. So there is a bit of a disparate picture across the globe, but generally it's been, as we know, quite a high inflation scenario. Some encouraging figures yesterday actually from the US in terms of inflation and where they're heading, which has certainly buoyed markets over the last 24 hours, which has been quite nice to see. Against that backdrop, very much a monetary tightening backdrop as well. So then moving to the chart on the top right there, thinking about central base rates, thinking about the cost of money, the cost of borrowing, which again, as we pretty much all know, has been increasing at quite a significant rate. Pretty much a global phenomenon there. Yeah, there are some perhaps different examples. For example, China, where we've seen a bit of deflation, but certainly this increasing pattern in rates, and that's had a material impact in terms of investments and returns, and we'll look at those in a minute. But very much key for the UK market is what we've seen in gilt yields, the bottom left there. So really, the cost of government borrowing. And what this chart on this bottom left is showing is it's years along the bottom, and the rate at which the government can borrow or issue a gilt, a government bond, for that period of time. I think there's a couple of interesting things to note from there. Firstly is where we were back in December 21. So very low levels of rates, the blue line, sort of down at 1% across all terms. And that's a position that we've been in for quite a long time now in terms of very low rates historically, which has fed through into cost of borrowing generally, particularly mortgage rates that a lot of people are obviously talking about now. And then we can see where we are in June 23, and a significant increase in the yield curve there in yellow. And while the percentages on the left, it's a material increase to go from 1% to sort of 4.5%. In terms of numbers, maybe it doesn't look that great. But actually, when you're talking about borrowing at that length of duration, the impact in terms of the price of the assets is really, really significant. And we'll look at that in a second. So it's very much a picture of, I think, inflationary background, monetary policy being tightened, i.e. banks looking to sell bonds rather than buy bonds, which is what they've been doing up until very recently, the so-called quantitative easing being reversed. And the movement in the yield curve into what we call an inverted yield curve as well. And you can see that one of the differences between the yellow curve to the blue curve is if we look at the near term, so sort of 1 to 5 years worth of borrowing, the rates are higher than they are for the longer term. Now that's something that you would not necessarily expect. You would expect if you're borrowing over longer term, rates would be higher because you'd want a bit of an extra premium, a bit of an extra return for the fact you're buying that longer duration instrument. We're not seeing that in the market at the moment, and that's partly a reflection of the levels of inflation we're seeing now, which are expected to come down. It's part of the pricing in of inflation expected to come down. But I think it's also it can be a predictor of a recession. I'm not saying it is, but historically where you've seen that inversion in the yield curve, it can suggest that returns might not be so positive going forward, which is probably not the scenario we're in at the moment. So I don't think it indicates that, but I think it does indicate the expected fall in inflation that is expected to be certainly priced in over the next few months. So if we look at market returns and what's been happening over the recent period, and again, this is very much a story of bond yields, I think. So if we look at the blue to begin with, that's the returns over the calendar year 2022. So that's last year. So what happened in markets? And we're pretty much negative across the board, and that's probably not a surprise there from anybody who's been watching markets at all. But very much, I think, a lot of the action has taken place on the right there in the bond market again, particularly driven by this increase in yields. Now, on the previous slide, I spoke about the move from sort of government borrowing costs of 1% up to about 4.5%, which, it's a material move, but it sounds quite small moves in numbers. But every 1 percentage point can have a material impact on the price of a bond. And if a bond is 20 years, roughly on average, let's say, to payment duration, for every 1%, you'll get a 20% increase in the price of the bond. So you have this sort of quite significant multiplied effect. And that's really where we see those massively negative returns on the right there, the bonds and cash. So particularly government gilts, index-linked gilts, and sterling corporates, so corporate bonds, returns of at or close to minus 40% over those 12 months periods. That is really a reflection of what we've seen happen in the longer dated interest rate market, the government borrowing costs. And then that has fed through into a number of different areas. In terms of pension funds, it's really affected the value of the liabilities. The liabilities have generally fallen very, very heavily. If you've been holding bond investments, then typically they've been hurt quite badly. If there is an upside to that story, obviously it would be liabilities, values have fallen, and pricing for annuities has fallen as well. So if you want to buy an annuity today, that annuity will be significantly cheaper than it would have been had you been looking to buy it 12 or 24 months ago. So if you bought one 24 months ago, that's probably a bit of a tough story, but very, very material returns, as I say. So if we sort of then pause for a second and think about looking forward, where are we likely to be going now? And you can see we've said some key drivers are the cost of money. It is that interest rate environment. It is that inflation environment. And we are in a different position now with interest rate levels back to more normal levels. If you look at historical interest rates, and they are published all the way back to about 1750 for the Bank of England, and you took an average of those sort of levels of rates, you would expect maybe 3-4% would be a reasonable long-term interest rate. So actually, although we've seen quite a significant increase, and maybe they're above the long-term trend, they're not that far above the long-term trend. Actually, another way you could look at that would be to think about the Bank of England target of 2% inflation. If that's the target, plus a little bit of real return on top of that, you can actually see quite easily how a 3% interest rate is not an unreasonable level of return in the market generally. So I think what I'm saying another way is where we've come from in recent history, returns of 1% or what have you in terms of interest rates, that was probably artificially low and probably somewhere we're not going to get back to, certainly in the near term, if it ever happens again. So amidst that backdrop of what we've called interest rates normalising, and as I've said before, I think we can tell from the market the prediction is that inflation will fall, and we're beginning to see signs of that in various economies around the world, less so in the UK, but there is some hope that the lag factor will begin to feed in and we'll see that those inflation numbers come down. I think there are some what we've called geopolitical risks about that, particularly in terms of wage pressure, sort of industrial unrest. That might continue to keep that inflation picture there, so it's something to watch going forward. But what it does mean in terms of expected returns, and what we're seeing most market commentators predict, is quite healthy returns, both from growth assets, from equities and similar. And as I've said, yields on bonds are higher, so bonds are much more attractive now than they were even 12, 24 months ago. And if you think that you can go and buy a corporate bond or a high yield bond and lock in a return of 5, 6, maybe 7% if it's in a high yield category, that's not a bad return actually to be able to achieve at this point in time. So there are some there are some favourable returns out there. Another key word we've got there is sustainability, and that is very much obviously something I'm thinking there when I talk about sustainability. I'm thinking about ESG. I'm thinking about environmental, social, governance issues. Yeah, there is a challenge on definition, and I'll talk about that briefly. But we thought it'd be interesting actually to take a quick look at how different sectors have performed. And it's a very short period we're looking at because there isn't a long period of history here to look at, but to think about in terms of performance, so realised return, how have different strategies played out? And we've looked at 3 different categories here, which we've called all market, which is, so that's just the broad stock market. Here we're looking at the US market because that's probably the deepest market in that regard. But if we think about the UK market, the all market, we compare it to funds that are ESG in nature, so they're tilting towards environmental, social or governance issues. Typically they're ethical funds, named as ethical funds. There might be named a Future World Fund, that sort of name where they have some sort of screening or tilt towards ESG matters. And then what is called sustainable impact, and that's a fund that is trying to make a real social difference. And I think the way you can think about sustainable impact funds is they're generally focusing on the sustainable development goals of the United Nations, so the 17 goals they have around ending poverty, food for all, water for all, those sorts of elements. And the 2 charts on the left, the blue is performance over 3 years, annualized, and the red is performance over 5 years, annualized. And so it's going vertically up, we've got the performance, and horizontally we've got the risk. It's quite an interesting pattern actually, in the sense that there probably isn't a pattern there. But you can see that there is quite differentials between these returns. So if you look at the 3-year period, the broad market has done better. Look at the 5-year period, if you were investing in what's called sustainable impact way, you might have done better in terms of return. But then if you kind of delve into that, I think, and look at how the different sectors have performed, and some of those sectors will be weighted very differently in these types of investment strategies, you can see how they've really driven that performance. Particularly if maybe no surprise, over the last 3 years, given events we've seen in the world, oil and gas, metal and mining, energy, and metal and mining sort of, including thermal coal, we've seen really, really strong performance of up to 40%. And that's annualized returns over the 3 years period. So that could be 40% every year. So they're really big numbers. So if you begin to, I think what we're trying to say here is not question whether ESG is the right thing and the right investment belief to take, or not the right belief to take, but to think about how, when you begin to actually tilt towards sectors, it can affect overall performance. So it's really that point. And you can see, as I say, a number of different, radically different performances achieved from different sectors. So if you begin to weight your portfolio in different ways, it might have a return effect on the outcome. And I think indeed that element, so there's a number of studies now that are beginning to be, or have recently been published in terms of views around ESG and sustainability, both of investors and asset managers, and how the industry is generally moving that way. And you often hear the word polarized used, and so we've spoken here about is ESG becoming normalized or polarized. And the idea here is that what we're beginning to see is a lot more scrutiny on actually what ESG and sustainability means, particularly around definitions. So if you look at different portfolios that are, let's say, ESG tilted, sustainably tilted, they can look very different dependent upon the investment beliefs of the investors or the fund manager actually constructing that portfolio. So you do see quite significant differences. And we are beginning to see differences play out, I think, both globally and regionally in a sense as well. So where I said definitions matter, I think if we were, if you're a fund manager and you're looking to launch an ESG product, for example, in Europe, you're probably going to focus on sustainability around climate change and those issues, because that's where the demand seems to be. If you were doing the same in North America, you'd probably focus on diversity, inclusion and equity, because those are the matters that particular market is focusing on. And interestingly, if you were to go to the Far East, that's where there is a very good take-up of what is called sustainable impact. So you definitely see different views around the globe. And the industry then is reacting to that in different ways. So we're seeing some very large investors, particularly in the US, where there's probably more of a political debate, but some large states are beginning to take very particular directions in terms of whether they adopt ESG matters in their investment policies or not. And as they're very large asset investors, that does have an impact in terms of the market and how it moves. We are actually seeing, I think, more non-ESG options come to the market as well as ESG options. So we've got a wide plethora now of funds that are available that have tilts towards sustainability, but some asset managers which now have a range which are tilted towards a broad market. So they're more concerned on what they would call fiduciary duty, ultimate returns, than thinking about ESG. Now, there is a big debate about whether tilting towards ESG does improve performance or does impact performance in a negative way, and that goes back to the previous chart that I showed, but it's certainly something that is on people's minds when they're thinking about where to allocate assets. And we're seeing the discussion play out both at the individual company level and at industry-wide level and sectors as well. And we've given two examples there. Shareholder engagement, so the idea here that pension schemes or other shareholders should be using their voting rights really to drive social change. There's been two really interesting cases recently for two US oil giants, Chevron and ExxonMobil, whereby the boards of those companies want to move in one particular direction. The main shareholders voting, the likes of BlackRock, Vanguard, State Street, have wanted to move in a different direction. And you then have the asset managers and their view through the voting for their clients moving the company in a direction which the boards think will actually hurt the value of the company. So it's quite an interesting dynamic, I think, beginning to develop there in some areas. And recently we saw what is called the UN Net Zero Insurance Alliance, which was an agreement across insurers to target basically carbon neutrality, I think by 2030 from memory, which has since folded. A number of insurers have pulled out of that and decided that they actually can't replicate that in their portfolio, so they decided not to move forward with that. So we're beginning to see, I think, the challenges of implementing some of these ideas and the practicalities around that. Certainly one of the things we've seen for our clients in terms of ESG and sustainability is heightened governance, so awareness of these issues, thinking about it, how they bring it into their portfolio, whether they do, and that debate, and thinking about what the matters should be considered, and then the reporting around those matters as well, because some of that reporting is actually quite deep, quite broad. Anyone who's had to put together a TCFD report where you literally have to look at the whole portfolio and disclose everything to do with climate, do some modelling, some metrics of sustainability, will know that that is not a trivial task. It's very, as I say, very large and deep and quite expensive to do that work. And there is a drive through for the regulator and guidance to reflect policies regarding sustainability within Statement of Investment Principles for schemes, and then not only to have that policy, but trustees to ensure that policy is being implemented and report on how that is being implemented through the annual implementation statements. So there is a link to get trustees of pension schemes to think about these matters, to embed them, and then actually to report on them. So it's becoming that full sort of circular link there. So that was some thoughts on ESG. I thought we'd wrap up by just touching briefly on the Mansion House reforms that were presented at the beginning of this week by the Chancellor Jeremy Hunt, just to give some thoughts there. So I think that the high-level points that we saw come out were a keenness to encourage pension schemes as deployers of large amounts of capital to invest within what is called unlisted equity, effectively private equity. The idea being that pension schemes are, as long-term investors, they can take the risk and the potential additional returns that will come from being in unlisted securities and trying to tap into that market, both by encouraging DC schemes, by having this goal of having 5% of all default funds invested in unlisted or private equity assets by 2030, and finding a way through regulation and encouragement to get local government schemes to invest more of their assets into these unlisted type of vehicles going forward. Interestingly, in that, in what I've read, and it may be that I just haven't seen it yet, there was nothing that actually, although it's encouraging schemes to go in that direction, it didn't seem to be any incentives in there necessarily to encourage investment in the UK. And generally, if you're going to look at an unlisted equity portfolio, you'd probably start from a global perspective, and you'd probably look at the US and other areas, particularly the Far East, before necessarily focusing in the UK. Yes, there are areas of strength in the UK, but you'd probably take that global view. I think the push continues to have consolidation across DC schemes to bring the assets together. That's certainly something we're seeing, to what I would call professionalised trusteeship, in the sense of improving knowledge and understanding of pension fund trustees and thinking about actually how they might, and consulting, and there's a number of consultations been issued actually following these reforms, but thinking about how they might actually keep track of pensions trustees' knowledge and how that could potentially be checked going forward. Defined benefit super funds legislation is again going to be consulted on and brought forward. The super fund is think of it basically as an alternative to a buyout. Basically, like an alternative to an insurance buyout. It's partway between the PPF and partway between an insurance buyout as an option. It's a very complex area in terms of scheme administration and implementation, and I think legislation, if it can be brought forward there, will actually be quite helpful to move that area of the market forward. And I think lastly, to link it back to the ESG sustainability point again, we saw the launch of what is called the Mansion House Compact. I'm not quite sure why all these things have to be called compact, but it seems to be essential in terms of all the ESG things these days. But that's very much a voluntary agreement across a number of insurers, such that they will look within their default funds of their DC arrangements to have an allocation of 5% to private equity assets by 2030. And I think it's very encouraging that schemes are looking to do that, because pension investors are a long-term natural buyer of that illiquidity, so that makes a lot of sense. But I make the caveat that it is voluntary, and we shall see how that plays out over time. I mentioned earlier that the insurance agreement that was based around sustainability was voluntary and didn't manage to be fulfilled. So I don't wish to be a cynic, but we shall see how that one plays out looking forward. So there's a lot of I think there were 5 or 6 consultations launched on the back of this. So there's going to be a lot of industry discussion. And it's very much a continuation, I think, of the government nudging pension funds in a certain direction to deploy assets that are very aligned with development needs of the UK generally. But quite interesting, given up until recently, pension funds have been encouraged, particularly to invest within gilts, to buy bonds, to buy LDI. There's a little bit of a change of tack here, in the sense of you should be looking to buy unlisted assets. You should be looking to buy longer-term growth assets. So I think there's a bit of a change there. I think that one's my last slide, and I'm probably up against time. So, are we doing any questions down? Yep. Okay. Thank you. Does anybody have any? Andrew.
Morning. On ESG, if I may. How high up on agendas is ESG? Or is it something that's more talked about in the industry than amongst clients?
Good question. It's certainly something that features in regulations, and the latest DWP initiative is to encourage pension schemes to think about a number of these issues. So I think as advisors, certainly are putting it in front of pension schemes, because it is something that trustees should be aware of as an expectation that they will be considering these matters, and indeed in some ways there is an obligation to reflect policy within some of the documents, such as the SIP. The degree to which it's being discussed, in my experience, very much depends on the beliefs of the individual trustee board, perhaps the beliefs of the sponsor as well, and how those fit together. It's very interesting. There was a study that came out the other day, and it was a very, very good study of looking at quite a broad, widespread of schemes across the globe. And over the last couple of years, a significant number of schemes have been looking at ESG. And what's happened now is the number that are looking now at ESG is really reduced. and that polarisation has happened. They've either become quite heavy adopters, perhaps because it fits with obviously their thinking, their investment beliefs, maybe the beliefs of the corporate, or they focused on what you would call fiduciary duty. And the ones that have moved to think about fiduciary duty, which is basically just thinking about returns first and foremost, the reasons they cite for looking at that tend to be not quite sure about returns, which goes back to the kind of variability of sector return that I was talking about earlier, and difficulties actually in getting the products and the investments that match their beliefs. And it goes back to, I think, to the definition of ESG. And if as an investor you specify exactly what you want in terms of the different ESG characteristics, it can be very hard to match that up to an investment fund in the market, because it is in some ways very subjective.
You talked a bit about fiduciary duty. Is that one of the things that came out of the Mansion House speech, was the view that people are kind of incorrectly interpreting that, and there's concern that trustees don't really have the knowledge and experience to really get under the bonnet of some of these issues?
Yes, yeah, no, I think that's definitely true. I would agree with that. And one thing that seems to happen ever thus is the complexity increases. Investment products, asset classes, it becomes very difficult to keep a grasp on those. And I think that is certainly one of the pushes behind the desire to move to consolidation. The thinking that if you can do that, you could actually, in a sense, maybe it's not the right word, but professionalise the pension fund industry in the way that some other European countries have done that. I think quite an interesting sort of benchmark is perhaps the Dutch experience, where they have gone through very similar to a number of the reforms that have been mentioned in the Mansion House reforms, collectivising defined contribution, professionalising the pensions trustee market, and nudging the industry towards pooling assets, and therefore having people with perhaps more experience of managing those assets, managing a larger pool of assets rather than more of a diverse spread across a number of pension schemes. I think that's quite interesting, because if you think about what the kind of trustee role is as a sort of prudent person on the Clapham Omnibus or whatever it's called, as a trustee, do you need to have this level of detailed knowledge? Obviously, you do need to have some, but I think you also need to have that that level of prudent oversight, I would call it. And if you pull everything together, there is a danger that you do end up all herding and moving in the same direction, I think, particularly with regards maybe to some asset classes and some particular investments.